and welcome you tune into Commodity Central with me, Ankita Saxena. We'll take you through all that's transpiring on the commodity front. And we have a new kid on the block, CleanMax EnviroEnergy Solutions, a renewable energy provider that is all set to make its D-Street debut next week. We caught up with Kuldeep Jain, who's the CMD of CleanMax, to discuss the company's expansion roadmap, the sector outlook, and what the investors can expect from this IPO. Let's listen in.
We own renewable energy power plants and sell the green power directly to corporate customers. The other listed companies make and sell green power largely to power distribution companies who then distribute it to a corporate customer. We make and sell our green power and we sell it directly to a corporate. We have more than 550 corporate clients. 85% of them are credit rated AA, AAA or India subsidiaries of multinationals. And there are really two big segments for our business. First is data and AI. So AI infrastructure and data center clients account for about 43% of our contracted volumes as of October 25. The other 57%, the other segment, is largely manufacturing and infrastructure assets in India who use the green power to reduce their power bill as well as reduce their carbon footprint. So, there's cost savings of about 30% on power bill for them, as well as, reduction in carbon footprint. So both of these segments are growing very, very fast because firstly, data and AI, you know what kind of rocket ship growth it is, and that's 43% of our business. And corporate power is a huge market. It's about 3 lakh crores in size. Only about 7% of that market is today buying bilateral green from players like us. And because people are saving and for doing the right thing, they are also adopting green very quickly, and that is slated to grow, powering growth for us.
Interesting. So let me understand this a little more better. It's basically that you have the renewable power plants which supply and you contract them to the customers, whereby it's through an SPV mode where they will have at least 26% stake in the company, so that it becomes a captive power for them in that sense. And it's a net off that happens for them from a consumer customer's point of view, right?
That's right. So, we have the benefit that customers invest 26% equity for their direct consumption. That is rightly, as you said, called a group captive model. So these are for long-term contracts. So on average, 23 years is the power purchase agreement duration. And in group captive model, customers put 26% equity. So there is that invisible equity contribution lock-in as well. Physically, though, we are not near a customer's premise. We make our solar or wind power at the place where we are making the power. We inject it into the power grid, and the customer continues to draw power from the grid, and it nets off in the energy bill at the end of the month. So there's no inconvenience in adopting this to the end consumer. That's what I would say.
How do you see the major segment like a data center segment growing, because it constitutes nearly 46% of your contracted volumes, and the way we are trying to ramp up data centers in India, we're looking at 20-25 gigawatt by 2030 or so. What is the kind of path that you have in that sense for the data center business?
So sometimes history is an indicator of the future, Sajid. So if we looked at our business in March 24, we had about slightly below 250 megawatt contracted with data and AI clients. But as of October 25, this number has risen to above 2200 megawatt and accounts for about 43% of our contracted capacity. So as you can see, 10x kind of growth we have seen in the last 18 months. This is driven by two types of users. One is global big tech customers such as Google and Amazon and several others who are contracting to offset India and non-India emissions from these kind of plants. Second big driver of this growth is data centers located in India and we have more than 6 or 7 data center customers, serve them across various states. They have seen high growth as well. And absolutely, Sajid, we've all read in the press about how much is coming in the field of data and AI. And I do see, therefore, that this should be a continuing growth driver for us.
And how are you prepared for it? Because currently, if I look at your balance sheet, you have a total borrowings of over 10,000 odd crores. You're using this IPO to pay off roughly 1100 odd crores of debt. How is the scale up from here for you?
So if you look at our past growth, we had EBITDA growth of 58% year on year for the last three financial years. And if you say what will be the continued outlook, as of October 25, we have about 6,000 megawatt of contracted capacity, of which as of October 25, only 2,800 megawatt was actually operating, and another 3,200 megawatt was slated is slated to come on stream in the next couple of years. And that, as you can see, is an indicator of high continued growth. We have a strong balance sheet, I would say, Sajid, because our net debt to EBITDA ratio is only about 4.6x compared to industry average of about 5.6 times. So compared to other listed renewable energy companies, we have lower borrowings. And yes, we are being prudent and using some of the IPO proceeds to pay off debt. But on a continuing basis, we are well positioned to continue funding the next few years of continued high growth.
All right. So that's the management of CleanMax, the IPO that opens for subscription from the 23rd of February to 25th of February. But let's move on and get an earnings candidate.